So let's start, right? Hi everyone, welcome to Datable's podcast, where we discuss latest trends and insights in technology and finance. Today's episode is focused on blockchain and digital assets regulation. I'm Demre Sirel as a host. I'm excited to dive into today's topic with our expert guest, Alicia Blackett.
Hi.
Welcome, Alicia, and thank you so much for joining us today. To help our listeners get to know you better, could you please tell us a bit about yourself and your areas of expertise?
So I'm Alicia, and I've been involved in information security for over 10 years now. I had the great pleasure to be able to use those security skills to enter the blockchain and cryptocurrency market in 2021, where I was a security auditor looking at smart contracts, looking at the implementation of particular blockchains, and it was a very exciting time. I've since progressed, and now I am involved in the full security and GRC implications of using blockchain technology. I was previously an engineer, so I'm very passionate about the technology from a technical perspective, but also from cryptocurrencies as well, and their value for investment.
Yeah, great. Thank you. Today, I want to focus today's topic and want to start with blockchain technology, actually. For me, and actually for all, we all heard about Bitcoin and other cryptocurrencies. But what really powers these digital currencies is the technology called blockchain. And it's a game changer that's set to revolutionize everything from finance to healthcare, like supply chain, any industry, actually. And as we look ahead to 2024, the buzz around blockchain just keeps growing. And so maybe you will mention what exactly is blockchain. Maybe give a brief about from scratch.
No problem. Basically, this is why blockchain technology is so exciting. It has so many applications. But to describe the actual technology, I just want us to go back to 2008 when we had the financial crisis. And if you look at some TV reports at the time, you will see people in Greece and also in the UK, and they were queuing outside of their banks trying to withdraw their money, but weren't allowed to. And this is one of the issues with having a centralized system within banks, because there's a single point of failure, and that is either let's call it the honesty of the banks, or also they can also have technological faults. And what you're also relying on is that the bank has an up-to-date and true picture of what you have in your account. But also the bank can change that amount if they want to, if there's some kind of malicious activity behind them, whether it be a worker or something like this. And this is an issue that really touched, whether it's a group or a single person, we never know, but it's Nakamoto. And basically in 2008, he said, I'm working on a new way to transfer digital value. And this is where digital assets come in. And he started with a data structure, and that data structure was a distributed ledger. And what's special about this data structure is the fact that it's immutable and it's append only. So what happens is that any information that's added to this data structure is always added at the end, and it's added in blocks. This is how we get the idea of a blockchain. The blockchain is literally what it says. It's a chain of blocks, and they're all interconnected using cryptography. And what this means is, if, for example, the transaction that you've made, if you've transferred value from yourself to someone, or someone has transferred value from them to you, this is recorded in the blockchain. So there is never any argument about whether or not these values are correct, because these transactions have been verified by a big pool of nodes. So it's not just one bank saying this is the amount that you've transferred. You have all these independent nodes who are behaving with integrity, and they basically perform the verification of transaction. They make sure that you actually do have that amount to transfer. They make sure the amount is actually transferred to you or to the other person. And this is recorded in a ledger. And the reason why it's called a DL, distributed ledger, is because all of the nodes that take part in this verification have a copy of this ledger. So at any time, if you want to query how much is in your account, you can actually do this via the ledger. And the ledger is public, and this is what makes it important. And what blockchain also brings us, as well as this idea of integrity, it's also this idea of fault tolerance. So if we have a number of nodes within the US, we have a number of nodes within Turkey, a number of nodes within the Netherlands, if the US was suddenly to lose all power or electricity, what you have, your entitlement when it comes to the cryptocurrencies you hold, you will always have that. It's not dependent on any particular group of nodes, but the behavior, the honest behavior of nodes as a whole.
Yeah. So you mentioned that once a block is added, it can be changed, right?
It cannot be changed. This is what makes it immutable. This is what makes it such a powerful technology.
Yeah, like it's making everything real transparent and secure.
Exactly,
right?
Exactly.
And it's also maybe really hard for hackers to mess with, because there is no central point to attack, actually.
Exactly. This is what also makes it secure, the fact that if a hacker wants to attack or change the values in the blockchain, they literally have to attack every single node that has a ledger. And also, even if you attack the node, how do you change the ledger when all the blocks are cryptographically connected? It's impossible.
Yeah, and everyone in network has access to same information, which builds trust, and it also creates benefits, like it builds the trust, like transactions are quicker, cheaper, since also they don't need, like blockchain technology don't need any middleman, right?
This is it. I mean, this is one of the benefits of blockchain used in cryptocurrencies, in that they cut out all the intermediaries. Really, if you want to take part in cryptocurrencies and buy them and sell them, all you really need is to have in your possession your own wallet. And you can have different types of wallets. You can have a software wallet, and these tend to be browser based, or you can have a hardware wallet, which is something like Ledger, and which is actually a little bit more secure than using a software based wallet.
Yeah. And it's like, the blockchain technology is also evolving fast, and some of the latest projects are really pushing the envelope. For instance, Ethereum, right? This one is a big for creating smart contracts and decentralized apps. So what are some of the maybe coolest, the most important blockchain projects and innovations you've seen recently? Can you maybe share some real world examples?
Yeah, what I will do is just go back a little bit and talk about why things like Ethereum are so important. So as much as Bitcoin in itself was a game changer, there were a number of issues that people saw with it. One, it's its ability to scale. Another is the time it takes to create transactions, and which is, I believe, 10 minutes, around the 10-minute to 60-minute mark. And also the usefulness of it. What can we actually do with it apart from transfer Bitcoin from one address to the other? So one of the contributors to Bitcoin was Vitalik Buterin, and he actually founded Ethereum. And what he wanted to see was a base that's based on a cryptocurrency and based on a blockchain technology. So at the time, it was also proof of work consensus. Now it's moved over to proof of stake. And what he wanted to build on top of that is a layer of programmability so that we can actually exchange values, but in more interesting ways and in more ways that actually replicate how the markets work now. So we still don't need that intermediary. We use smart contracts, and this basically provides the functionality to then create anything from loans to lending, borrowing, liquidity pools, and the usual kind of synthetics and derivatives that you see in the financial markets.
Can we say the big companies follow this trend and use this trend in their operations?
I think the fantastic thing about blockchain is that it can be used in any market. With regard to cryptocurrencies, I think there are a number of the bigger banks, especially investment banks, who have seen the potential and have created their own chains. Other financial institutions are looking at creating their own stable coin, because one of the issues with borrowing and lending is the volatility of cryptocurrencies such as Ethereum and Bitcoin. And it can be the situation, if you don't use stable coins, that you can borrow an amount of money. Let's say you can borrow 50 Bitcoin, but by the time you pay back 52 Bitcoin, the actual underlying price can be 2 or 3 times what you borrowed. So this is quite an issue when it comes to actually building these liquidity markets so that people can actually borrow and lend funds and actually get a return on it as well.
Yeah, and of course we we touch the cryptocurrencies like Ethereum and Bitcoin, but our Ethereum and Bitcoin are perhaps the most well-known digital assets. Actually, they serve as a form of digital currency that relies on blockchain technology to function without the need for traditional financial institutions. So decentralization also offers numerous benefits, including lower transaction costs and increased security, right? So then we have NFTs, or non-fungible tokens, unlike cryptocurrencies, which are interchangeable. NFTs are unique digital assets. So they can represent anything from digital art to virtual real estate. And what fascinating about NFTs is that they are stored on a blockchain and ensuring their uniqueness and ownership. And then in recent times, we've seen some remarkable projects in the space also. For instance, NBA Top Shot allows users to buy and sell digital highlights of NBA players, and platforms like OpenSea have become more popular marketplaces for digital art and collectibles, right?
Yes, absolutely, absolutely. There are some fascinating uses of non-fungible tokens. There are some also when it comes to, I would say when it comes to digital art, that the beauty is in the eye of the beholder, as they say. And what I like are more the functional uses of NFTs. For example, sports companies and sports clubs, soccer clubs, actually using those to sell their own sort of merchandise, using those to sell tickets, concert venues using NFTs to sell tickets for famous artists. When there's an actual sort of use behind it, I think it's fantastic technology. But I think when it comes to digital art, we have to be very careful as investors. Now, although I can't give investment advice, I'm not a licensed individual professional, what I would say is that when you look at having an auction for a particular thing, whether it be digital art or physical art, you can either say that the person that actually bought the end product was the winner, or you could say that they were also the loser. And you can say they were the winner because they were able to find the finances to actually pay for digital art. But you could also say that they were the loser in that they may have been the only person that thought that that piece of art was worth that amount. So that's why I'm a little bit hesitant about digital art and also meme coins, but very much love anything to do with NFTs being used in manufacturing or being used for ticket sales or something where there is something a bit more tangible behind it than just art.
Yeah, like also there isn't some thoughts that NFTs are like trash, right?
Yes, yeah, you can have NFTs as trash. You can also have something called S coins, and I think you know what I mean when I say S coins. So we have to be very careful when we enter the market. I would say to anybody who was looking to buy a particular coin or particular art or even particular currency, really don't give in to that feeling of that fear of missing out. Always go to the website, go to the GitHub repo, look at the white paper, just see if it makes sense, if it makes some kind of economic sense, or if it's selling something that you want, something that you know you can trade. Just to look a bit more sort of deeply into how it functions before actually buying that particular coin or NFT.
Yeah, actually, when we talk about like NFT and blockchain, we always touch like decentralized finance and Web3. Somehow they're linked to each other. But for beginners or new learners, maybe we will also dive about decentralized finance and Web3 and what's their what's their importance about like finance in industrial based. Also, why they have an effect in our lives or in industry. Are they really important, or they already change our lives, but some of us just aware about it, but the rest of us not aware about it. So I just want to understand decentralized finance and what's going on this area and Web3 applications in recent days.
Absolutely, absolutely. When it comes to decentralized finance, what we need to look at, again, going back to some of the issues that we have with centralized finance, the accessibility for everyone to actually be able to invest. And if we look at finance through the ages, whether it's a person or it's actually a nation, basically we all need the ability to borrow money to actually make money. And that could be anything on a personal level to, for example, buy property, to buy a home, or for governments, it's having that, being able to borrow a certain amount of money to then invest it in their people, whether it be to attract foreign finance and create manufacturing plants, or to help their health service, anything like this. So the actual need to be able to borrow money is fundamental for the growth of not only people's finances, but the finances of nations. And this is something that blockchain does, and cryptocurrencies do, because in the old kind of centralized finance, there is this intermediary. And this intermediary is the one that determines whether or not you are able to invest in a particular scheme. And they can look at perhaps your credit background, they can look at where you live, they can look at the type of job that you do, or they can look at how much savings you have, and they can basically say yes or no whether you can invest in a scheme. What's great about cryptocurrencies is there's none of that at all. If you've got a computer, if you've got access to a computer and you can work a browser, and we'll go into cyber hygiene when we talk about security, but as long as you're very careful about protecting your private keys, then there are a number of DEXs out there, decentralized exchanges, that you can either lend or borrow to try and improve your finances. You can either hold a particular currency hold a particular currency in your portfolio. I was just about to say in your wallet, but that's not how it works, in your portfolio. Or you can actually stake that currency. So if you have, for example, 5 or 10 Bitcoin and you want to stake them, then you can earn the equivalent of interest on that on that particular financial oh, sorry.
That's fine because we can edit. That's
right.
Yeah, if you want to, you can repeat the last sentence or wait, as you wish.
I'll repeat it actually. Yeah.
Yeah.
So, or you can stake that money. So basically, you. Sorry, I've gone again.
That's fine. I'm also sometimes doing it, and we are free as long as you want.
Thank goodness, thank goodness. So you can either stake that cryptocurrency and in that way actually earn interest on your investment.
Yeah, that's fine. No, great. So when we talking about all these contents, we use regularly two words: lending, borrowing, lending, borrowing. When it comes to lending and borrowing, is there any authority to regulate these all technology, or this technology already born because avoid to regulation? So I want to understand the current regulations, or are there any legal developments in the like DeFi, in Web3, or blockchain technology?
There's different regulations dependent on what the blockchain is used for. So if you're using blockchain technology, for example, for medical devices, then there are a number of privacy laws, and I believe the HIPAA law would also apply to any information that you were gathering from these basically information, basically an IoT of medical devices. When we look at cryptocurrencies and the whole kind of decentralized finance area, that's where it gets very, very interesting. And we can see different approaches to regulation, and we can see basically what the end result is. For example, if we look at the SEC, they seem to have a more slash and burn approach to cryptocurrencies than other national regulators. And their approach appears to be they want to take particular blockchains or layer 2 technologies to court to prove whether or not they are securities. Now, one of the reasonings that the SEC has for its stance against cryptocurrencies, because it is quite negative towards cryptocurrencies, is that cryptocurrencies themselves have a number of negative properties that it's trying to stop. Now, one of these negative properties is volatility. However, if you see the reaction of the markets, every time the SEC loses a court case, then you see that they themselves are actually bringing the volatility as well as other market conditions. If you compare that to the EU and the MiCA law, and also Singapore's digital payments law, then you see a more helpful situation. And I was at a conference the other day, and there was an American there from one of the major blockchains, and he said, basically, there's a lot of not so much investment money, sorry, but what's it called?
That's fine. The point is, so I mean, I don't want to stray from content, but let me maybe you can, you can repeat it, and after I can ask, because I want to touch also, does all these regulation needs or requires big budgets? So
that's an interesting one.
Yeah. Also, I want to understand who is the pioneer about the topic. I mean, maybe EU acts like it's the regulator. Also, maybe US have its own framework. Singapore has its own framework. Or we already have one framework, one authority regulates all this DeFi or like cryptocurrency or blockchain.
Oh, that's a good question, actually. Oh, that's gonna be very interesting. Now I've completely forgot what I was talking about in the first place. Which point to go back to?
Yeah, because why I'm interested in it, because for instance, European Union just announced an AI Act and trying to regulate all these developments about artificial intelligence. Also, US just announced its own regulation. So we don't stick just one framework. So maybe, yeah, there is a big, of course, like DeFi is something different, kind of like blockchain is something, is all these areas is different and big areas, of course, but how we regulate and do we need big budgets?
Yeah, so basically the regulations are separate. On the one hand, you have the SEC in the United States with their regulations, but obviously because of the broad reach of America, it can in some ways be seen as worldwide in some respects. Yeah. So for example, the SEC banned the use of a facility called Tornado Cash, which aids privacy of transactions on cryptocurrencies. And basically, if I in the Netherlands were to use Tornado Cash and then went over to the States for some reason, then I could potentially be arrested because I'd used something that's already been sort of sanctioned. So every country, so also the UK has their own implementation of let's call it a crypto assets law, the EU as well, and also Singapore. What's special about the EU regulation, and this is something I actually agree with, is that it targets centralized exchanges that sell cryptocurrency products. And what it does, it's twofold. One, it brings these cryptocurrencies not only under those regulations, the specific cryptocurrency regulations with regard to the information they have to provide, for example, in their white paper about how they do business, how they promote themselves, how they market themselves, but it also has the potential to then bring it underneath other European Bank and Authority regulation, such as their regulations with regard to the technical implementation of security and risk management of IT infrastructure, which is very important. What it also does is look at anti-money laundering and counter terrorist funding. But again, these are areas where you'll find that cryptocurrencies play very little part in. Actually, they get a very sort of bad reputation, always been used by criminals and terrorists, but actually it's still cash and still banks are the main providers of money laundering. So what I like about the EU's regulation is the fact that it brings then central exchanges under the regulations with regard to the security of their infrastructure. Because when we look at security, we see that it's their infrastructure that has, so their Web2 infrastructure that's been attacked more as opposed to their Web3.
Great. Actually, yeah, I mean, this caught my attention because most of the authorities also not deal with each other and there is no handshake at all. We still try to regulate and trying to create rules, maybe, right? So, and maybe we can, I mean, I'm curious about, but, well, just a minute, just a second. We just talk about regulatory framework, I think. And should we go with security risks, or maybe we talk about impact of regulations on the digital asset markets? Are there any like good or bad impact that these regulations bring the digital asset market?
The biggest impact that seems to be apparent within the cryptocurrencies market is more for starters, people who have developed a cryptocurrency and are looking for funding and investment. And a lot of that funding is now coming from US investors because they fear actually funding cryptocurrency and blockchain projects in the US because they fear the regulation that might come afterwards. However, what you find in MiCA, the EU's regulation and Singapore's regulation, at the start, they do say, we have brought these regulations in to encourage the use of DLTs and to encourage cryptocurrencies. And I think that's a big difference. And I think we'll see more development and more interesting projects taking place within Europe and within Singapore, East Asia as well.
So there isn't also kind of risk to shift their investments, like other countries?
Yes, I would look also to, I know countries like Switzerland kind of fall in and out of the EU when it's quite handy for them, but also they've been very proactive in attracting funding for cryptocurrencies. And at the end of the day, what seems quite strange is a lot of these countries, including the US, are creating their own stable coin. So to have this kind of negativity behind cryptocurrencies and yet embrace it with creating stable coins just seem a little bit bizarre. But as long as nations within the EU and East Asia can benefit from this, then yeah, why not?
So what means stable coins, by the way?
So again, it goes back to when people want to actually borrow money, and the fact that the base coins such as Ether and Bitcoin are so volatile that you can actually end up owing more than you actually borrowed in the first place. So what a stable coin does is you can add it to a liquidity pool, and this basically makes sure that any volatility that is seen with lending is dampened, basically. So it's not 100% because there are different types of stable coin. If it's natural fiat backed or asset backed stable coin, then there's less risk. We have seen, however, some algorithmic backed stable coins having issues and actually crashing and depegging. So there's always a depegging risk, but at the moment, it's one of the safest ways to actually get involved in lending and borrowing.
Great. I mean, there isn't regulations. Why there are regulations? Because there isn't risks. So what are the certain risks or most popular risks that we already facing?
There are a number of risks with regard to investments. So there are the usual that the return that was promised was not received. We need to perform our due diligence when we're looking at investment projects. That means going into channels such as Twitter or Discord, going onto their GitHub repos, having a look at the code. If you're technically minded, download the code, play with the code. You can also perform a security analysis on the code. There's loads of tools out there to do that. So we need to also look at the economics behind a particular project. What are they offering? And these help to reduce the sort of the normal investment risk that you have also in, let's say, the normal sort of financial world. But then we do need to have a look at how the security as well is implemented within these projects, because this is a big issue. And certainly when projects first started and projects were first hacked, it was a matter of loads of errors within smart contracts. Also not an idea of what being public actually means. And that means once that smart contract is deployed, it's out there and it can't be changed. So if you have hard-coded private keysing, which is another, which used to be a popular hack when smart contracts sort of first came out, these are security practices that increase the risk for investors that overnight that their investment could be worth nothing.
So, I mean, at that point, Alicia, I want to ask, if we skipped something important, I just stop it because if we skip important thing, or do you advise anything? Okay, we need to go back there and we need to mention, because the content is very big and wide. So do you have any recommendation that I can ask a question to you and you can explain, or maybe you, I mean, how to, I don't know. It's because the point is what I'm thinking about. Of course, we talk about regulations, but maybe we need to special focusing on the security and risks, or maybe we can mention about aspects of the security. What's the security measures and what users should be aware of, kind of content. What do we advise?
I think because I think you know the audience better than I do, that you know which content they're looking for. So I'm looking for your guidance.
Yeah, that the point is, we already mentioned about like digital assets, popularity, and etc. But in regulation and security, as an expert, maybe in regulatory framework, we mention from different countries' frameworks.
Yeah.
Right. But maybe we need to explain the audience. For instance, US has own framework, Singapore has its own framework, but what's their differences? For instance, maybe US focus Act A, but Singapore focuses like Act B, right? Maybe there are different focus points or pain points, let's say, from different countries. I'm very interested about what they focus on. So what's their major points when it comes to maybe in regulation, maybe about risks. So maybe you can give a brief about risks that country is aware of or put in the first place.
Sure. So when it comes to the United States, and I think actually this is, there are similarities and differences into how regulations have appeared in different countries. Now, all countries are basically interested in this particular cryptocurrency or particular token. Does it look, feel, behave like a financial security? So does it actually behave in a similar way to a bond, sort of paying back that regular interest rate? Does it behave in a way like a synthetic, or does it behave in a way like a derivative? And if that's the case, then it should be regulated. And this is certainly the approach that the SEC has taken. And this is why its framework is basically to prove through the courts whether or not something is a financial security. So their driver is really to take court action, and it basically gives notice to a number of cryptocurrencies, for example, like Ripple, that it will take them to court, and at the court stage, it has to appear before the judge and prove whether or not it's a financial security. And for companies like Ripple, they were very successful in proving, no, they're not a financial security. And this is where there's this big difference in how the SEC, which governs financial securities in America, behaves, and how the European Banking Association behaves in Europe. And what the European Banking Association has said is that, okay, if the particular cryptocurrency token or particular asset, if it does behave like a financial security, then you will be regulated under laws that already exist. But for the crypto digital assets that don't fit in this category, it's still beneficial for investors to have some kind of protection. And that's why they have created these new laws like MiCA to actually give added protection to investors who invest in digital assets which don't behave like financial securities, but do still carry a certain amount of risk. And as you say, it is this new technology that not a lot of people know about. And within the market, amongst customers, amongst investors, there is this kind of fear of missing out. And what that basically does is that it encourages sort of people to try and invest in something that they know is going to, let's say, double in price or something like this overnight, which a number of cryptocurrencies have done. That they are quite volatile by nature. So what these regulations do is reduce the risk for investors. Now, one of the downsides about bringing in regulation is that period beforehand. And what we've actually seen in the markets is that there's been a greater release of what I previously termed S coins, because there are some criminals out there, and they are trying to make as much money while they can. And so they have released a number of coins. And if you go to particular websites like Coin Market Cap or something like this, you can actually see comments on the side where people say, oh yeah, buy this particular coin, it's fantastic. Now at the moment, all of that is not regulated. So when a cryptocurrency or someone who's bought that particular cryptocurrency makes these false basically predictions of price, that at the moment is not regulated. And that's what we need to actually help the investor to be able to see when something is potentially fraudulent, and when something does have the potential to actually grow into a really good really good investment, something that will actually pay back. There have been a number of issues, that the number of risks basically that regulations are trying to iron out, and one of them actually is, and I would say, this is why I do say to people who want to invest, you really do need to look into the contracts, because sometimes it's written in the contract that if you want to actually sell this currency once you've bought it, you have to pay something like 70% of the value of that particular digital asset back to the owners. So what regulation is doing is trying to protect investors and allow them to actually sort of take part fairly in an investment market.
So what about 30%?
So one of the benefits of cryptocurrencies, and this is the whole sort of decentralized and why they were created, is that at the end of the day, you have to one, pay for what you use. Is a bit like if you have an AWS or GCP account, but also you want to actually incentivize validators to actually sort of take part in the chain and validate payments. And that's what these cryptocurrencies do. So usually if you are going to sell a particular token, there's usually a gas amount that you pay. So you do have to pay something, but 30 and 90% is a little bit high.
Yep, I think so. So, well, I mean, there are already developments and risks, and actually, as a public, I think also we are going to learn from our recent developments, and most of the, like, maybe there is a new investors, like new joiners in the digital asset markets. So what are the new innovations, or what are the new trends in the industry? It's already evaluating. There is an evolution in the industry. So maybe we can, or you can share your predictions about the future of blockchain or digital asset market. Are there any potential innovations?
I think the most important one, because it goes back to the security for the investor, I think one of the most important ones is the actual ease and security around using wallets. Because the first kind of wallets that we use, at the end of the day, a wallet, the only thing it holds, because it doesn't hold your cryptocurrency, the only thing a wallet holds is two keys, two cryptographic keys. One is a public key and one is a private key. And what we need to make sure is that we do not at any time lose the private key or expose it, because basically the saying is your private key, your crypto. If you don't have control of the private key, then it's somebody else's crypto. So what we have seen, and I think it's called this new abstract model for wallets, is an easier way for people to use wallets and not be as prone to being hacked or actually exposing the private key. What we see is now MPC, which is multi-party computation, and this basically is the use of more than one key to actually activate a wallet. So if you have a wallet that has 5 keys, then you will need 3 or more keys to actually transfer the digital asset, and this helps with security. When it comes to actual blockchains, we are living basically in a more decentralized world. So we're going to see DLTs, the distributed ledger technology, actually in everything from energy production to new software-defined vehicles. I do believe one of the bigger manufacturers actually uses blockchain technology to deliver these new software updates in a secure fashion. As you say, we also see it with medical devices, because again, we need to actually deliver data, immutable data, in a secure way, and that's what a blockchain can do. And again, it goes back to its principle of fault tolerance, that it's used in this decentralized process.
Great. The point is, again, I have some stuffs that if we follow all the topic and cover all these sublines, so yep. Should we mention about Web3 application, and we can cut and put it in very beginning?
Sure, yeah. So for Web3 applications, what we see is, on the one hand, we had something called metaverse, and this, funnily enough, didn't take off quite as well as I thought it would. But I do believe with the addition of generative AI, it probably will come back again and come back again with force. And the metaverse was this area where you could, for example, buy property, invest in property, and actually sort of have an investment scheme in that way. It was also supposed to be a learning environment. So there was now going to be, and this was something that was especially important over the COVID period, that we were able to study at home, but immerse ourselves in the whole experience of being at university, because that's what the metaverse was going to do for us. There have been a number of applications for decentralized apps, or DApps, and basically that could be anything from games and gaming, and what we basically use tokens for there is to actually purchase goods within gaming. So one of my favorite games is a driving game, and if I want a better car with a better engine, then I have to buy tokens within the game. We also see casinos coming about, so we have Web3 gaming and Web3 gambling, Web3 casinos. So there's such a big area that this will grow into, that it's going to be a very, very exciting area. So that's the applications of DApps. But what we also want to see is real world assets being tokenized. Now, this, especially in the financial world, is the next big thing. Can we tokenize house sales so that there's not the intermediary of having to go to, certainly in the UK, the Land Registry Office, to prove that you actually own a particular property before you sell it, and then have it registered, which incurs a number of different costs, including solicitor costs. If we can sort of tokenize houses, then it cuts out the intermediary. But what it also does is, if you are someone who does not have the opportunity to purchase a home yourself and you are renting, then you'll probably see house prices rising, thinking, well, it would be helpful for me if I could invest in that rise as well, if I could take part in that rise. So what tokenization can do is, instead of one person owning an investment property, then a number of people can own it, and a number of people can take part in the actual profits of it. So this is an additional income. So real world assets, tokenization is going to be the big thing for the future when it comes to the financial world.
Yeah, but also there isn't, I think, high risks, because we, the younger generation, I mean, lose our focus easily and quickly. For instance, I remember that in my experience, after pandemic, we talk about having property in metaverse world, right?
Yes.
But nowadays, nobody interested, at least my environment, and they lose their attention, they lose their focus. And sometimes also I heard about some critics that, okay, I ruin my earnings like that. So it's like an NFT. I mean, there isn't risks. Maybe there are risks that maybe people are maybe have regrets in the future.
Absolutely, absolutely. And again, it goes back to doing the due diligence, doing the research into the project, and thinking about not this fear of missing out, but how well is this project described? How useful is it? And I think it's the utility part of it that is going to be the most attractive and determining feature of whether it will be a successful investment or not. And what we actually see is when you look at the different types of tokens that you can have, you tend to find that it is Bitcoin and Ethereum that are kind of more platform based, more sort of settlement based in the actions they perform, that these tokens are more long standing and have more stability than something like a meme coin.
Definitely. I mean, there isn't risks and there isn't rumors even. So we can see, but still we can see that these cryptocurrencies still have a big potential, and people or new investors also were interested with have cryptocurrencies, and people consider this wasn't a good investing for their future too. And already most of the national banks trying to regulate this area and trying to like protect the investors. Also, they trying to prevent like breaching, also financial frauds, and etc. So yeah, there isn't a bunch of risks. Also, there is a bunch of potential and good impacts when it comes to the like financial sector. Not just financial sector, of course, there's in healthcare, like as you mentioned, like supply chain, manufacturing,
Everywhere, yeah.
everywhere, literally. And Alicia, before we sign off, is there anything else you would like to add, or any resources you recommend for our listeners who want to dive deeper into the world of blockchain or digital assets?
I would say keep in contact with Datables. There'll be great information and content there.
Great.
I'm also an avid reader of Medium. That also contains a great amount of content. If you want to get in there and get playing, and I really suggest you do this, whether you're a developer or investor, or maybe even both, is to look at particular sites like CoinMarketCap or something like this that actually shows the particular currencies. It shows the top 20 of the currencies. Go onto their pages, have a look at GitHub, have a look at Discord, have a look at Twitter, what they're doing. Do some research to find out if it's something that you do really want to get involved with, and think about also how long you want to stay with that investment.
Yeah. So, that brings us to the end of today's episode. We have explored the incredible potential of blockchain technology, delved into exciting world of digital assets like cryptocurrencies and NFTs, and discussed how decentralized finance is revolutionizing the financial sector. I want to extend a huge thank you to Alicia for sharing your insight
Anytime.
and expertise with us today. And thank you for all tuning in. And until next time, keep exploring and stay curious. And thank you again for listening to us.